In recent years, there has been a surge in the popularity of stablecoins, particularly the USDT and USDC. These cryptocurrencies are designed to maintain a stable value by being pegged to a fiat currency such as the US dollar. However, with the emergence of central bank digital currencies, there is a growing concern that stablecoins may become obsolete. In the video, we will explore why CBDCs could potentially erase stablecoins like USDT and USDC. Firstly, CBDCs are backed by central banks, which means they have the full faith and credit of the government behind them. This gives them a level of credibility and trust that stablecoins simply cannot match. In contrast, stablecoins are backed by private companies, which may not have the same level of credibility or financial stability as central banks. This could make investors and consumers more hesitant to use stablecoins, particularly if there are concerns about the financial health of the company behind them. CBDCs have the potential to offer a wider range of features and benefits compared to stablecoins. For example, CBDCs could be used to facilitate faster and cheaper cross-border transactions without the need for intermediaries such as banks or payment processors. CBDCs could also potentially offer programmable features such as smart contracts that would allow for more complex financial transactions. In contrast, stablecoins are generally limited to the features offered by their underlying blockchain platform. CBDCs could be seen as a more secure and stable alternative to stablecoins. Stablecoins are often subject to price fluctuations and volatility, particularly if there are concerns about the stability of the fiat currency they are pegged to. This can create uncertainty and risk for investors and consumers who rely on stablecoins for their financial transactions. CBDCs, on the other hand, are designed to be stable and secure, with their value pegged to a fiat currency or basket of currencies. CBDCs are likely to be subject to greater regulatory oversight compared to stablecoins. This is because CBDCs are backed by central banks, which are typically subject to strict regulatory requirements. In contrast, stablecoins are often unregulated or subject to minimal regulation, which can make them a risky investment. This lack of regulatory oversight could ultimately lead to the demise of stablecoins, as investors and consumers opt for the more secure and regulated option provided by CBDCs. CBDCs have the potential to be interoperable with other payment systems such as traditional banks and payment processors. This means that CBDCs could be used to facilitate transactions between different payment systems without the need for intermediaries or complex processes. In contrast, stablecoins are often limited to the blockchain platform on which they are built, which can make them less flexible and less widely acceptable. This lack of interoperability could ultimately limit the usefulness of stablecoins and lead to their eventual demise. CBDCs have the potential to be more accessible to a wider range of users compared to stablecoins. This is because CBDCs can be issued and managed by central banks, which have the infrastructure and resources necessary to reach a large number of users. In contrast, stablecoins are often issued by private companies which may not have the same level of resources or infrastructure. This can make it difficult for stablecoins to gain widespread adoption, particularly in countries where there is limited access to digital financial services. CBDCs have the potential to be backed by government support and public resources, which could lead to a more stable and secure digital currency system. This is because governments have the power and resources to regulate the currency system and maintain the stability of the economy. In contrast, stablecoins are backed by private companies, which may not have the same level of resources or government support. This could make stablecoins more vulnerable to financial instability and volatility. CBDCs have the potential to be integrated with traditional financial systems, which could make them more widely accepted and easier to use. This is because CBDCs could be used to facilitate transactions between traditional banks and payment processors without the need for intermediaries or complex processes. In contrast, stablecoins are often limited to the blockchain platform on which they are built, which can make them less flexible and less widely acceptable. CBDCs have the potential to offer greater security and privacy compared to stablecoins. This is because CBDCs can be designed with advanced security features and privacy protection, such as encryption and anonymity. In contrast, stablecoins are often subject to security breaches and hacking attempts, which can compromise the security and privacy of users. CBDCs could potentially offer a more secure and private alternative, which could make them more attractive to investors and consumers. As the world of digital currencies continues to evolve, it will be important for investors and consumers to stay informed and adapt their strategies accordingly. While the impact of CBDCs on the digital currency landscape remains to be seen, it is clear that they represent a significant shift in the way we think about money and finance. And with that being said, it's time to end our video. Subscribe to the channel for more amazing videos like this. We'll see you with another interesting video.